Hey everyone, welcome back to the channel. If you're new here, I'm your name, and today, we've got a juicy topic that many people get confused about. Mutual funds versus permanent life insurance. Yep, you heard that right. Life insurance is making a surprise appearance in the investment world, and trust me, you're going to want to hear this. Now I know you might be wondering, why are we talking about life insurance in the same breath as mutual funds? Well, buckle up, because I'm about to break it all down for you, and I promise it's not as boring as it sounds. You'll probably learn a thing or two, and if you're already an expert, you might just have a few aha moments. Before we dive in, make sure you hit that subscribe button and turn on notifications so you don't miss out on more money-smart content. And hey, don't forget to share this video with anyone who's ever wondered if life insurance and mutual funds should be on the same investment list. Spoiler alert, they really shouldn't be. But we'll get to that. Let's start with the classic, mutual funds. A mutual fund is like a big investment smoothie. It's made up of a bunch of different assets, like stocks, bonds, or other securities, and you get to drink it all at once. The idea is simple: diversification. You can invest in a wide variety of assets without needing to pick individual stocks. Imagine if you wanted to create a smoothie for breakfast. You could buy a bunch of fruit, veggies, and other ingredients, blend them all up, and voila, one healthy breakfast. But, as we all know, not every fruit is easy to eat on its own, so you toss them all in there and let the blender do the work. Mutual funds are the blender. The fund manager is the one picking the ingredients, making sure you get a good mix. Mutual funds are usually actively managed or passively managed. If it's actively managed, a team of experts is buying and selling stocks inside the fund to try to outperform the market. But if it's passively managed, like most index funds, the fund simply tracks a specific index, like the S&P 500, and doesn't make any fancy moves. So the key benefits of mutual funds are their diversification, professional management, and the fact that they're relatively easy to invest in. You don't have to worry about choosing individual stocks because the fund manager is doing that for you. But, and here's the catch, you also pay management fees, and those fees can vary. Think of it like paying for a top-tier personal chef who preps your meals, but you also have to cover the cost of that 5-star service. Sure, it's nice not to do the cooking yourself, but it can add up over time. Alright, now that we've got mutual funds covered, let's talk about permanent life insurance. Don't freak out. This isn't the same thing as term life insurance, which is just there to provide coverage for a set period. Permanent life insurance covers you for your entire life, and in some cases, it also has an investment component. Think of permanent life insurance like a combination of a life jacket and a savings account. On one hand, you're getting the life insurance coverage, like that life jacket keeping you afloat, and on the other hand, you're building up cash value that you can borrow against or even use as an investment vehicle. Permanent life insurance is typically broken down into different types: whole life, universal life, and variable life insurance. Each of these types has different investment options and levels of flexibility. For example, whole life insurance has a fixed premium and guaranteed cash value growth, while variable life insurance lets you invest the cash value in a portfolio of stocks and bonds. So, why would anyone choose permanent life insurance? The main selling points are the lifetime coverage and the cash value growth. The cash value grows tax-deferred and can be used in a pinch if you ever need a loan or to help with retirement. But let me be clear, this is not a get-rich-quick scheme. The growth is often slower compared to mutual funds, and the cost of premiums is significantly higher. If mutual funds are like the blender for your investments, permanent life insurance is more like a piggy bank. It's there when you need it, but don't expect it to make you rich, unless you really like paying for that piggy bank for a long time. Now that we've covered the basics, let's compare these two heavyweights, mutual funds versus permanent life insurance, side by side. Investment purpose, mutual funds, designed to grow wealth over time by investing in stocks, bonds, or other assets. It's a vehicle for capital appreciation. Permanent life insurance. The primary goal is life insurance, but the cash value portion is there to build a small savings that grows over time. The main purpose is financial protection for your loved ones, with an extra perk of building some cash value. Mutual funds are like that friend who loves going to the gym to get shredded. Permanent life insurance, on the other hand, is like the friend who wants to be financially responsible but doesn't really have time to focus on their six-pack abs. Fees and costs. Mutual funds. There are management fees and sometimes sales charges, also called loads, but they tend to be lower than permanent life insurance premiums. Permanent life insurance. Premiums are much higher, and there are fees associated with the life insurance and the investment component. Plus, you're paying for the death benefit, which isn't something you get with mutual funds. Think of it like this. Mutual funds are like a Netflix subscription, pretty affordable, and you can cancel anytime. Permanent life insurance is more like buying a luxury car. High initial costs, but you get a lot more protection in return. Liquidity. Mutual funds. You can buy and sell shares at any time during market hours, which makes them much more liquid. Permanent life insurance. You can borrow against the cash value or cash out the policy, but it's not as liquid or easy as selling a mutual fund. So, if you need instant access to your money, mutual funds are your go-to. Permanent life insurance is a bit more like having a safety net. It's there when you need it, but you can't always get quick cash out. So, after all this talk, the big question is, which one should you choose? Well, it really depends on your financial goals. If your goal is to grow wealth over time, and you're not worried about paying for life insurance, mutual funds are likely the better choice. They're flexible, they offer great diversification, and they come with lower costs. If you're looking for financial protection and want something that will provide a lifetime benefit to your family, with a little savings bonus on the side, permanent life insurance might be a better fit. Just be prepared to pay more for that coverage. Ultimately, you need to think about whether you're looking for protection or growth. Do you need your money to grow and build your retirement? Or do you need to protect your family's future while building a small nest egg? Both options have pros and cons. Alright folks, if you've made it this far and you're now an expert on mutual funds versus permanent life insurance, give this video a thumbs up. And hey, I know you have that one friend who's still on the fence about which to choose. Go ahead and share this video with them. It could save them from making a costly mistake. Don't forget to subscribe and ring that bell so you never miss out on more financial tips and tricks. Drop any questions or thoughts in the comments below. I love hearing from you. Until next time, keep learning, keep investing, and remember, your money, your future.